If you are confused by what the heck is going on in today's market, I want to talk you through a lot of what I just learned today with Barry Habib, one of the top experts in the mortgage industry, to help set the story straight and to really give you the market knowledge and the knowledge in general that you need to make compelling cases for helping your clients do the right thing. So let's get right to it. I don't want to waste any time because a lot of this is very fresh in my mind. But in short, right, there are headlines. There's a lot of information and misinformation out there, a lot of fear being pushed about what's coming in the housing market. And while we all acknowledge, right, nobody can predict the future, nobody really knows what's coming, there was a lot of data that was provided by Barry that really made the case that in all likelihood, prices are not going to go down. They're going to continue to go up. And that's a case, honestly, that you have to take with a grain of salt because anybody in our industry is going to be incentivized to keep that narrative going. But what I was most impressed by was the level of data that supported the predictions, right? Anyone can make a prediction off the cuff. Anyone can say whatever they want. And whether there's fact behind it sometimes gets lost in the shuffle. But the level of data that was presented was very impressive. And I'm a data nerd, so it takes a lot to get me to that point. But I want to kind of bring it down to a nutshell for you. And I don't have slides to support this. I don't have any of that data, but bear with me because, again, in this podcast, on the show, one of the key aspects of separating yourself from your competition is your level of market knowledge. And that goes beyond just your local market, but being able to talk high level about what is in the headlines, what's in the papers that people are seeing and digesting on a daily or weekly basis, and being able to bring context to that. So one of the main arguments is that, obviously, again, what goes up must come down, right? We've had the hottest few years in recent memory. It has to come down. Well, there was a slide that Barry had showed that there were periods similar to this where, honestly, even back in the 1940s, and I know we're going back way in history here, where there was over 100% increase in appreciation over 4 or 5 years. It took 43 years of continued appreciation past that for house prices to come down, and they came down a whopping 1%. After that, it was consistently going up until the financial crisis, which he spent a lot of time talking about the differences between then and now. And the main drivers being not only inventory being less than half of what was out there during the financial crisis than we have right now, but also obviously the lending standards, right? During that period of time, that was the loosest lending standards that have ever been in existence. And obviously you reap what you sow in that regard. So that was another component. But at the same time, there was a very interesting slide that I'm going to look a little bit deeper into that compared home formation or household formation compared to new builds or completed builds. And back in the early and mid 2000s, those graphs started getting out of alignment where the builds outpaced housing formation. And the main question I was going to ask, but he answered it before I had a chance to. We obviously saw that home builders adjusted and knew less homes were being built over the coming years up until about 2008, 2009, when they bottomed out. But the household formations fell off a cliff really in 2006. And I didn't really think that he was going to have a concrete answer as to why that was. And it may be more complicated than this. But in a nutshell, the average home buyer age or household formation age is 33 years old. You go back 33 years from 2006 and you get to 1973. And you look at the birth rates that happened, and the birth rates from 1972 to 1973 fell off dramatically. And after that, those trend lines between household formation and birth rate by year were relatively in alignment, going upwards. Now, you look at what is going to happen this year and next year. It is more of the same. Those household formation rates may end up being in alignment with those birth rates, and those birth rates are continuing to go slightly upward. We're not seeing any huge spikes until another decade from now. But between now and that next coming spike, there's some up and down, but there's nothing massive. I don't think that there's anything enough to kind of sway me from that opinion that if those have historically been aligned, and it's an interesting fact to follow, the only other component that I would be curious to see is, besides household formation, would be, I guess, what I'll call household deterioration, right? As the boomers start to die off and the population goes downwards for that generation, how does that factor in? So that's one thing that I want to dig a little bit deeper into. But essentially, it explained away between inventory and that household formation why we are in such a different place now than we were. And it's something that I think in the industry, we're familiar with inventory levels. And I think that the public can get kind of numb to us saying, inventory is near all-time lows, it's lower. But often we don't bring the context, right? We don't necessarily have the data to say, hey, look, I know you're concerned about this being another 2008. Here's why it's not. So to be able to make that case using some of those points that I just provided you, hopefully will be helpful. But beyond that, another component that I think is important to follow, and I'm going to start tracking this myself, is really tracking inflation and CPI, and that inflation really is the key indicator for the direction of mortgage rates. Now, it's not a step-for-step change. If inflation comes down 0.1%, mortgage rates may not come down 1/10. They may go more than 1/10. They may be less than 1/10, but they should be directionally the same. And looking at the monthly CPI over the past 12 months, see a big chart really going back over the past few years, that is a measure of the prior 12 months. And when you have a month that is going to fall off like May, when it was a relatively elevated month from a metric standpoint, and the trajectory of CPI has been going downwards, you're going to see CPI decrease. And when CPI decreases, rates end up going down. So his prediction, and it's a bold prediction, is that by July, mid-July, he believes we are going to be under 6%, possibly as low as 5.5% for the 30-year conventional loan. Now, obviously, if that happens, that's going to be a heck of an opportunity for people who have been on the sideline or who have been nervous about the direction of things. But the inventory problem isn't going to solve itself. And the mortgage rates are only holding back demand as those rates go down, even if the underlying factor, right, is that there will be layoffs, that unemployment will go up. There will likely be more demand, and I don't have the specifics to back this up, but the point that he made was there will be more demand and more people now eligible to buy a home than those who will no longer be eligible. And typically in these layoff scenarios, and I don't like to I hate talking about this stuff, it makes me uncomfortable, but it's important to acknowledge that a lot of those layoffs, not all of them, right, are commonly in income brackets where they may not necessarily be homeowners. And it's sad to see anybody lose a job. You're never going to hear me say otherwise. And there is not a but coming. Acknowledging the fact that those lower rates are going to drive more demand than we will likely lose is important. So I was on the fence. I personally thought that this fall, and I made this prediction at the beginning of the year, that by the end of the year, we'd be down somewhere in the 2.5% to 5% range here in Ocean City. I don't really know about nationally. Every market is different, but I am really having second thoughts about that, not just because of this conversation, but I thought inventory would have been higher than it is now. But we've actually lost inventory on the year, which surprised me. I didn't think that that was going to happen. So all of that said, you really need to know this stuff. You need to be familiar and how to have these conversations. And I am not a salesperson. I'm not here to teach you scripts or specific, sales tactics. And if you're listening to this and not watching on YouTube, I air quoted tactics because I believe in having honest conversations and helping people make more confident decisions. Period. End of story. And if you're able to provide the data, provide the story and the cases for why you believe what you believe, and you really believe it, then you're going to be able to help more people, and they're going to trust that you are actually there to help them, not just trying to talk them into something that's going to benefit you. So that's it in a nutshell for today. We really need to focus on becoming the market knowledge leader because it's a huge differentiator, right? The conversations that you will be able to have with potential clients, with past clients, with anybody that stops you, while you're getting coffee and asks you, hey, how's the market going? You're going to be able to blow people away by the depth of conversation that you can have versus the typical agent that they're going to run across. So I hope you found this helpful. If you did, do me a favor and hit like if you're watching this on YouTube. And if you haven't already subscribed, make sure you do that, whether that is on podcast form or if it's here on YouTube. I would appreciate it. And any questions that you have, you can always contact me any of the ways you see in the description or the show notes. That's it for today. Thanks for hanging out. I will see you next time.